Hello and welcome to this extremely special conversation that we are having on the D2C wave in retail. Part of the CNBC TV18.com and Shiprocket presents D2C, the new dawn in e-commerce. Today we're going to talk about how D2C wave has impacted the CPG or the consumer goods and the retail industry, and also has pushed the envelope of brands and companies catering to a vast and fast changing consumer base. If the pandemic has taught us anything, it's taught us that we are able to find all our needs at our fingertips on our phone. And the people who do that and the people who make it happen are not only these D2C brands, but also the companies that deliver these products right at our doorsteps. I'm Mangalam Malu, and joining me today on what promises to be an extremely interesting panel right now are Dr. Anand Ramanathan, who's a partner at Deloitte India. Then we have Deepak Gupta, who's the Chief Operating Officer at Bombay Shaving Company. We also have Kirti Avasarala, who is the Chief Product Officer at Meesho. These are all products that and companies that you interact with on or lately have been interacting with on a very regular basis. Arman Sood, the co-founder of your favorite coffee, Sleepy Owl, joins in as well. Cyrus Master, who is the Chief Business Officer at Mama Earth, joins in too. You all know how big a wave these products and these companies have made already. And then we have the one who stands at the backbone of them all, Atul Mehta from Shiprocket. He's the COO of Shiprocket, joins in as well. Shiprocket, of course, is responsible for delivering all these products, if not delivering most of these products, if not all of these products at our doorsteps as well. The D2C industry, roughly around $33 billion as per a report from Avendis recently, has the potential to actually triple by FY26 and turn into a $100 billion industry. Thanks a lot, gentlemen, for joining in. And I'm really excited to have this conversation with you. And that brings me actually to the first question itself. All these CPG companies, we have retail companies, they're scaling up, they're optimizing their operations. But this is also posing a challenge for all the logistics companies in terms of order fulfillment. The customers want their orders as soon as yesterday. How are you guys tackling this sort of situation? Let's start with Shiprocket first, because they're the ones who are actually making these deliveries, and then we go across the room. Atul.
Yeah. Thanks, Mangalam. Good to be talking to everyone. I think you're right. The consumer needs the products faster than ever before, right? It's like Ola and Uber, where in the past you were fine with booking a taxi and getting it 2-3 hours later. Now you want it within a few minutes. I think the way we see it, a key element of driving faster speed is how closer you are to the customer, right? How are you using warehousing and fulfillment solutions to replicate your goods across? I think over time, Amazon, Flipkart, and other marketplaces have told us closer to customer is a key component of being able to deliver faster speed. Warehouses which operate 24/7, and hence, even if you're placing an order late in the night, processing it overnight and be able to dispatch them early in the morning in the local cities or in the local states and delivering it within 24 hours is a key. Today, we deliver 30 to 35% of orders within 1 or 2 days, and we have a goal to get to 60 to 70% of orders delivered through 1 or 2 days. And I think the way I see it, getting closer to customer is a key component of how we can be quicker to the customer.
Well, that's a fair point there. Let's go across to Arman then. Arman, your product is a product that customers won't want to wait for over 2 days or 3 days. How do you navigate through this? And from where you started to where you are right now, how has the delivery and customer ordering journey been?
There are two aspects to this, Mangalam. We are actually working with platforms like Zepto, Blinkit, Swiggy, Instamart, etc., and do list some of our fastest moving products on their platforms. The larger assortment is available on Amazon, where we are able to get 1 to 2 day delivery. So on our direct to consumer website, we have not till now focused on doing the 1 hour, 2 hour, or even the 1 day, 2 day delivery game. We have recently though partnered with Shiprocket to utilize their warehouses to be able to deliver to customers from our direct-to-consumer website in 1 to 2 days. But we have still not decided if we need to work with any partner to get down to the 1 to 2 hour delivery model and build that capability or pay that extra that it would take to do that. Because we do feel that there are others building in this space, and it's better to utilize that and ride on their back, to be able to do this well, rather than, being available 1 to 2 hours across the board, because that is not feasible and it poses its own set of challenges. So that's how we are looking.
Interesting point that you're making out here, and that brings me to Dr. Anand Ramanathan. Dr. Ramanathan, have you done any sort of analysis or studies on the impact that delivery times have on additional sales? If a product is available, say, 2 days earlier or 2 hours earlier, how much incremental sales do they generate? And at what point is it most efficient to have that cost benefit sort of thing, where this is what you spend to maximize your sales? Have you done any of that?
Sure. So Mangalam, what we have seen is a couple of things, right? So one is it's very important which category you're selling, because there are certain categories which are very occasion-led, which lend themselves to gifting, which might be because of a festival around the corner. So many of these kind of products will be very impacted when it comes to delivery times. And in fact, delivery time is perhaps as critical as various other aspects of the business model, right? So one of the things we've seen post the pandemic is that it's very important to look at unit cost economics, because that ultimately makes delivery sustainable. Right. So how is it that you can bundle things cleverly? How can you look at subscription offers? These are also very important elements which help in improving the delivery proposition. And the other aspect is also, see, whatever you do, there will always be challenges in terms of customer expectations being fulfilled. And therefore, one aspect which typically gets ignored basis whatever we saw is the people side of things, right? Because the last mile is a challenge, retaining people, training them, and getting them to deliver on the promise. And if they fail, managing that customer expectation and turning that into an opportunity is also very critical, right? So these are some of the aspects which have repeatedly made the difference between good delivery and great delivery.
All right, let's get Misho in as well. Kirti, we all know that customers are now in the driver's seat. The buying choices, they're endless. What makes you stand out, or what is it that you do to retain long-term customers and perhaps reduce customer churn? As was pointed out earlier, that customers are fairly fickle-minded right now when it comes to a lot of variables. If a product is even priced well, doesn't deliver on time, chances are that churn may increase. If a product is delivered on time, is not priced well, the churn may increase. What is it that you guys do?
Yeah, I think at Misho, our mission is to democratize internet commerce. And where India is positioned today, a big part of the growth is coming from what we call Bharat, right, which is the tier 2 and beyond low to mid income segment. And Misho is sort of squarely positioned to deliver value to them. And the expectations of these customers actually are very different from the metro tier 1 upper to mid income segment that we normally look at. And if I look at this segment, I think for them, pricing is actually the most important thing, because all the consumers have high aspirations but are limited by means, which means the more affordable you make the products, the more likely that they will buy them. And also the biggest driver of long-term retention for us is actually having the lowest prices and also the largest unbranded selection on the platform. Having said that, in addition to these, I think the core delivery experience does play a very big role. But because the categories that we sell are largely fashion, home products, accessories, etc., which these Bharat customers want to buy, there I think the delivery time is important, but the frame of reference of the delivery time is different, which means that these customers don't expect something to be delivered in 1 day or 2 days, right? For them, pricing is more important than the speed, absolute speed per se. Having said that, we have seen that whenever we have reduced delivery times from, for example, like 6 days to 5 days or 5 days to 4 days, we have seen improvement in long-term retention, right? So that correlation is very clear, but that caps out at a certain delivery time. Right? For example, if you try to deliver it very, very fast, even earlier than 3 days or 2 days, probably it wouldn't make much of an impact because most of these customers are looking for pricing. So that's sort of how we look at it, right? So the best pricing, the largest long tail selection, that's the biggest driver of retention. In addition to this, I think the other thing which is very unique about Meesho, again, because we serve this user base, is a lot of our retention is also dependent on how social the experience on the app is. So for us, I think the USP is not that the e-commerce app will help you make transactions, but also is a place where you can come and spend time. Shopping experience is fun, rewarding. So a lot of our product investments actually have gone in that direction, right? How do we build a social community on the app? How do we have a lot of gamification on the app? So all of these again drive a lot of long-term retention. So to summarize, I think pricing, selection are the core pillars. In addition to them, I think delivery experience within a certain range of delivery times, I think is very important. And then a lot of social and community driven experiences on the app. I think all of these put together are what actually drive the biggest long-term retention for us.
Well, that's a fair point that you make. Long tail selection in terms of products and offering the best price would definitely go a long way in the kind of customers that you're catering to as well right now. And that again, let's go across to Zyrus. Zyrus, Mamaearth has been the first unicorn of 2022. We've seen the phenomenal growth path that it has been on. And now there is this growing geography of customers, which was alluded to by earlier. Tier 3, Tier 4 towns are also ordering a fair amount of products. What sort of fulfillment challenges do you face out there? What is it that you're doing?
Yeah, I think, I think this is at two parts. One is, of course, like what we've spoken of till now, that how fast can we get our products to consumers? And there I believe that, yes, at least in the space that we are in, it's not so much about how fast you can get, but it's also about some sort of, a confirmation of delivery times. If you say that I'm going to be there for you in 2 days time, then am I there in 2 days time or not? I think that's extremely important. The second thing that, for a player like us, we have a very wide portfolio. And I think one of the things that we also have to work towards is the availability of assortment. So, consumers can go to our website and wherever they are, they can choose whatever they want to buy. And then how do we ensure that that assortment is also available at the warehouse? That's when the D2C, the second leg of the delivery, actually takes over. So for us, it's a dual challenge. First, to make available our assortment at the nearest distribution point, and then secondly, how do we take it on? Also, I think e-commerce actually provides the opportunity where anybody sitting in any part of the country can actually order our assortment, and I think that's where we are seeing a lot of progress that's happened in the last couple of years, where there are partners available who are actually able to take even smaller brands across the horizon. So that's where we are.
All right, that makes sense. Finally, Deepak, Bombay Shaving Company, I'd like to know a couple of things. What would be your average order value be? What would the average frequency of purchase be? And how are things shaping up out there? Is there a possibility of quick commerce being making Bombay Shaving Company a product which everyone uses as real-time inventory? If I have to shave, I just make an order and within 10 minutes the stuff is here.
Yeah, so Mangalam, you are spot on. I think we are into the hair removal space for men and women. And if you look at shaving, within that space is a grab and go category. For example, if you want to get ready and you're out of your shaving cream or a foam or your cartridge, you want to just kind of buy it immediately, right? So we are an omni-channel business. But to make sure that for the top-up products, we are available all the time. So we are present with quick commerce with Zepto, Blinkit, Swiggy, Instamart, Flipkart, Shopsy, etc. Right? So to make sure that the consumer is never run out of Bombay Shaving Company products. But yeah, the other channels like our own D2C, we focus a lot on curating experience, personalization, and regimen selling, right? And we are also expanding our offline penetration to make sure that we are present in the neighborhood stores from where consumers shop apart from online. So So that's the focus. Our average order value differ for grocery. This is around 200 rupees, but on our D2C, it's close to 1,000 rupees, and on e-commerce will be in the range of 300 to 400 rupees. Given we are in the mass categories for hair removal for men and women, we see very high repeats, typically in the range of 4 to 5 times in a year.
Right, and then actually just a follow up there. How do the unit economics of quick commerce work for someone like you, where the AOVs are just around 200 odd rupees? If one has to top up on their cartridge or top up on their shaving foam, etc., will it make sense for you to deliver economically?
Yeah, actually, because see, quick commerce again, the infrastructure is not created by us. The infrastructure of delivery is created by the players like Zepto, Blinkit. We ride on that. In fact, I will say that quick commerce is actually more profitable to do rather than a D2C from the unit economics point of view, because you see high volumes, low inventory, and fast delivery, right? So you are closer to the consumer. So I see that this will grow going forward.
All right, this will grow going forward. Yeah, go ahead.
Yeah, I think it's an interesting thing which I don't know how it will pan out. Like, see, there were marketplaces which could do 1 day, 2 day, and then the shared warehousing ecosystem ensured that most of our goods as brands we can stock like closer to customers, and from warehousing we could do 1 day, 2 day. Now there's this stream of quick commerce which is like what Arman and Deepak both talked about, which is the Zepto, Instamart, and the Blinkit, but the consumer or the customer interaction is still with the marketplace and not directly with the brand. I think over the next 12 months, we'll see how quick commerce from captive digital destinations will pan out, right? Like, we are building infrastructure, and we know other players are also building infrastructure, extending the warehousing solution. Say, yeah, these are shared dark stores. You can keep the inventory there closer to customer, and if things pan out right, I think the incremental of the logistics cost might not be significant. Okay. And we have learned from, I think, say an Amazon, where if you want in 2 hours, if the ecosystem enables you to show that option to the customer and he's willing to pay 20 rupees higher, it might be even better than a 1 day, 2 day delivery, which you're doing from a warehouse, right? Obviously, a lot of it is the function of the demand of will the customer go to the captive digital destination, not to these marketplaces, and search for a 2-hour option, or will get excited about seeing a 2-hour option and will pay that maybe a 15-20 rupee premium. But I think because it wasn't there even in warehousing, it has gone to 1 day, 2 day, where outside marketplaces as brands or as digital entities, we can offer it. Will it translate into 1 day, 1 hour, 2 hour from the digital destinations? I think will be an interesting thing which we'll see more of in the next 10 to 12 months.
I think we'll know it only when we see it, because it's difficult to gauge. So let's go across to Anand once again. Anand, have you done any math here on how big the TAM of the quick commerce or Q-commerce business is? And what categories come under it?
Sure. So again, it's a function of geography. What we have seen is that the urban centers have really revived. I mean, people used to talk a lot about rural, etc. in the past. Somewhere there's a big revival. The one stretch in Bangalore, in the outer ring road between Marthahalli and Silk Board, constitutes about 2% of sales of the entire country for some of these brands, right? And I'm not talking about new age brands. I'm talking about established brands that have been selling for a long time. So the categories which typically lend themselves to quick commerce is stuff that you need to consume very quickly, right? So in the past, if we were to look at F&B as a category, as fruits and vegetables is what I meant by F&B, or if we look at FMCG, for example, these were not categories which lend themselves to D2C, and they've had their traditional challenges, right? Because unit level economics are very difficult to establish in these products. But what we've increasingly seen is that they've started using this hybrid model, especially in urban centers. We spoke of captive investments. I think it makes sense to choose your locations for captive investments and then use your network as well as your partner network to deliver. And that's where we've seen most of the successes happen. And it is in a few urban pockets. It might still not make sense for you to do it across the country because demand might not justify the investment. But having said that, the other trend that we are seeing is that Regional niches are again making a comeback, right? Traditionally, if you looked at logistics, typically there used to be pockets of the country which were served by specialized players, right? And you didn't have a national presence across the board for one large entity. Now we are seeing that again revive because logistics itself has become a business model differentiator. And if you're able to, particularly in categories which are relevant, make the product available quickly and efficiently. See, ultimately, it's a trade-off between three things, right? There is cost, there is service level, and there is time, right? So ultimately, it's this trade-off which has to be justified by the unit level economics of the category or the product.
You know, you've set me up perfectly for my next question when you speak about cost, service level, and the time for delivery. I'll probably go to Arman for this one first before I go across to all the others as well, because this question is extremely relevant right now in the D2C world. The average purchase, the average order value of D2C brands is a lot more premium than the average sales price of the mass category leaders out there as well. In times of inflation, you know, do you think there would be a fair amount of down trading? Because inflation is, I mean, with due respect to all the other authorities here, looks like it is here to stay. We haven't seen a petrol price rise yet, and it's pinching consumers' pockets. We hear them from large mainstream FMCG companies. So in a situation like that, how does this you know, metric of cost, service, and time pan out with the unit economics that you're speaking about? Anand, you go first, and then we ask all the others too.
Mangalam, I think we've already seen some of the large FMCG majors already increase their prices much before the startups have gotten around to doing it, right? So we don't necessarily see there being any down trading. I believe that most of us are offering superior quality products and have been around long enough to get customers hooked onto our unique offerings. And at least, you know, the average customer that we are catering to is discerning enough to want to stick to our brands and our products that they have been consuming over the last few years. And I don't think we're afraid of the down trading. Unfortunately, though, we too will be forced to increase our prices in some of the categories. You know, I think that is just what's going to happen. But we are hoping that this price increase does not lead to a large loss of orders because we do continue to strive to provide excellent service to our patrons.
You know, I have 2 points for that. The first one is that even after 5 to 10% increase by all these FMCG companies, they're still trading at a sharp discount to the average price of your products. I mean, anywhere between you guys are at least a 50 to 300% premium to you know, the traditional players, if you must. And the second point is that you guys can take some more losses because you all don't have you know, quarterly reports to give to the stock exchanges, and you are well funded by all the PE players.
Yeah, we're not looking to take those losses. We're increasing our prices further because it's what is the need of the hour to you know, grow at least a CM2 positive you know, bottom line.
Okay, well,
agree with that.
I know Mama product is at least 70% more expensive than the average Joe.
Yeah, you know. So look, in an inflationary environment, the danger of down trading is always real. But I think that's where brand marketers come in, and that's where I think that's the point that's being made. That the role of brands is to hold on to consumers in an environment like this. And I think that's the task. Having said that, I think this is a perfect time for each one of us to improve the efficiencies. And yes, you know, we've always tried to be efficient in the past, but efficiency, you know, typically has no limit. So I think that's what's going to happen. I think, you know, increasing prices is always the last decision that anybody wants to take. And therefore, the first thing that we would at least do is to work back in our systems and see how can we be more efficient, how can we bring in efficiencies, and also then work, you know, if you're increasing prices or, you know, at least keep the value the same. So how do we as a brand work to ensure that our proposition gets even stronger? That would be my point. But yeah, inflation is real and that's a challenge.
Well, that is a challenge. So let's, you know, let's go across to Kirti as well. Kirti, you said that you want your prices to be the best and your products to have the most amount of assortment. in a situation like this, how do you reduce costs and improve your operational efficiencies? What are the pockets where you see more room for improvement?
Yeah, I think given we're a e-commerce marketplace, I think a lot of the levers for reducing prices actually come from the cost structure of the company itself.
Yeah.
Because we don't control prices on the platform, right? There are sellers who are selling things at different prices. So the goal for us is how do we reduce their cost of doing business, right? Which can then in turn reduce prices on the platform. And if we take that lens, I think Meesho at least has been doing lots of innovative things. I think one of the biggest innovations which we did last year in June, July was to make commission 0% for all sellers on the platform. So that was actually a big lever to actually reduce prices on the platform, plus also get more and more sellers and suppliers onto the platform, right? So I think that's sort of one big way we look at price reduction. I think the other thing that we also do a lot is reducing the cost of fulfillment itself. And today, I think there is a lot of upward pressure on fulfillment cost due to, I think, multiple sort of challenges. One, I think, is because of the explosion in both D2C and e-commerce, the demand for fulfillment is much, much more than the supply of quality fulfillment, right? And the demand is growing much faster than the supply, which automatically sort of means that the prices go up for fulfillment services, which increases fulfillment costs. So the way we look at it is because we are a very tech-first type company, for us it's more about how do we invest in technology to reduce these costs. And a couple of things I think we've started to do. One, I think earlier people have spoken about this, but how do we get supply close to demand, right? So that the cost of fulfilling that demand is much lower, right? So get more regional supply, and also make that regional supply discoverable on our app, so that customers can order things from sellers which are closer to them, right? I think that's one big lever. The second big lever we've invested quite a bit in is consolidating orders, or making customers also buy multiple things together, so that then the logistics cost or fulfillment cost can come down. We've also invested a lot in machine learning or data science algorithms to reduce RTOs, which is basically when a customer refuses to accept the item which they ordered. So figuring out which are those customers who are exhibiting that behavior, and then figuring out how to optimize for that using data science, I think is another big thing that we've invested in, because RTO cost is also very significant. So I think, so this is how we look at it, right? Because we're an e-commerce marketplace, for us, I think it's more about reducing the seller's cost of doing business and reducing our own fulfillment cost through technology.
Makes sense. Deepak, how have customer acquisition costs panned out for you post-pandemic? Because it's increased manifold, right? During the pandemic, it was pretty easy for everyone to acquire customers left, right, and center. Now things are opening up. Now options are opening up. How has that, trend come up?
I think I can see a lot of smiling faces on the screen.
I saw that.
So I think definitely, I think the pain is shared with everyone. I think post-pandemic, I think a lot of brands have increased their digital spends, right? And ultimately, I think everybody is trying to reach to the same consumer. And a lot of brands are have come in. New brands have come into the D2C space. I was reading a stat, maybe from 2018 to now, maybe the number I moved from 600 D2C brands to 10,000 D2C brands in India, and a lot of money is flowing in. Yeah, so it has become expensive. I think that also puts a pressure on the brand to innovate a lot more, and that's something we are doing. For example, we have shifted from typical performance marketing as a core lever to sampling as a core lever. We're investing heavily behind sampling to make sure, because our products, especially the shaving products, are very close to nostril, right? So how do you make sure that more and more consumer try our product and then get convert there? We are creating experience centers in the malls to make sure that we reach out to the consumer in a different way from non-digital performance way. And thirdly is also we are doing a lot of partnership and alliances with similar brands where we share energy and leverage each other consumer base. So while performance marketing has become expensive, we have or even the brand investments are getting into a lot of competitive space, I think we are finding monetary and a more synergistic way to kind of acquire consumers and seeing some good results initially. Yeah.
Well, Atul, over the last few years, I mean, 18 months or so, we've seen a big increase in cost of fulfillment, be it manpower, be it fuel, be it logistics. All of that has increased. In a situation like this, what's the kind of increase that you've seen, and what are you advising to companies? How is that impacting the unit economics of all these companies?
So I think, yeah, while if you look at it at an absolute level, the cost of logistics would have increased by around 5 to 10%. I think some of the levers which Kirti also talked about, yes, some of the levers which Kirti also talked about helps us bring that under control as well, right? Like when you look at the logistics cost, it's a function of where are you moving goods from, whether you're moving goods 100 kilometers or it is going to do a distance of 1,000 odd kilometers. Getting supply closer to demand, building in intelligence on how do you ensure that every like your delivered percentage of what you're shipping out actually gets delivered for the end customer. And if you look at it, even a 3% increase in percentage delivery cost is more than enough to offset almost a 10% increase in cost, because what you end up earning on those 3% overall delivered goods is the GMV value, right? It's not about the cost, right? So building in efficiency both on being closer and building in some amount of a buyer intelligence around when to ship, when to double check before you're shipping it and we have seen it on our platform, brands being able to reduce the cost when the input cost would have gone up, because they have been able to sort of move from national shipping to local or regional shipping and building in some amount of data intelligence into to be able to reduce RTO, which Kirti talked about, has actually helped reduce logistics cost as well for certain merchants. And I think that's and the more we do it, the more closer we get, and the more data science we build in, is an opportunity we have to offset any future increase in the input logistics cost which is going to come.
Take that point. I'm just trying to figure out, in the US currently, there is a big decline that we've seen in the stock prices of all the D2C players, be it Allbirds, be it Chewy, etc. And there are three primary reasons for that. The first one is the cost of advertising has increased on account of Facebook, Google, all of them increasing their prices. The second point is that measurement of those ads have also become a little more muddled because of the various privacy policies that have come about by some of the large operating systems and cell phones. Apple, case in point, something like, even if India is largely an Android country. And the third one is that the total addressable population of consumers was earlier overestimated. Is that a risk that you see in India as well? I'll start with Anand because he's probably got a bird's eye view here.
Yes, so from a D2C standpoint, Mangalam, what we have seen is that the brands themselves have gotten into this space, right? That's what the pandemic did. And therefore, in some sense, sometimes supply creates demand. When you have your usual brand available online and it's being delivered to your doorstep, why would you go to a brand which you might not have as much confidence in, right? And therefore, what the pandemic did was to get this space, like somebody mentioned, 600 brands to 10,000 brands. And over and above that, you have the legacy brands also strengthen their D2C presence, right? And therefore, to that extent, we have seen some level of competition come in. And there have been two main areas where D2C brands have been able to still diversify and differentiate. One is when they are little niches and they use the online medium very well to build a cult following, right? So if you have very loyal customers, you're able to retain customers, you built a community. Some of the old legacy brands still haven't mastered that as a capability, right? And therefore, these are brands which still survive and in fact thrive and do very well. The second thing which we saw is that it is very important, especially in categories where there is a big services component and it's not just a sales component, for you to really have very good after-sales service, installation, maintenance, and all of that, right? And again, some of the traditional brands which have gone D2C are still struggling to put the service ecosystem online as effectively. And that is where some of the pure D2C brands have done much better, right? So these are some of the ways by which D2C has been able to differentiate itself. And these are going to drive their valuations, right? Otherwise, the market is very competitive, right? It's not just enough to be present in the market and spend on customer acquisition. People are looking at the bottom line impact, right? And increasingly, there will be more and more scrutiny on how you retain customers.
Cyrus, what happens to D2C brands? How do they scale? Because, I mean, getting from zero to a certain level is relatively easier than getting from a certain level to an even larger scale level. How do you grow there? That's point number one. And secondly, if you find it difficult to grow in a particular brand, you start the house of brands philosophy and try to get 10 brands to be 1,000 crores each, as against one brand being 10,000 crores. Is that why you bought B Blunt as well?
Look, firstly, I think how do D2C brands grow? I think D2C is just one aspect of a brand, which is if you are a digitally savvy brand, but that's your DNA. And then D2C is just one way to connect with your consumers. For example, we are an omni-channel brand. So we are present on D2C, we are present on e-commerce marketplaces. We now have our offline presence, etc. So I think that's the first thing that we have realized, that and there are different stages of growth. So for example, I don't think on day one we could have done physical markets, because it's not possible to reach out. D2C gave us the opportunity to reach out to 90% of this country almost immediately, and those advantages are there. So I think that's the first thing that I would say, that consumer brands, as they pick up scale, they go through different stages, and they need to put the consumer at the center and then build. The second thing is, I don't think brands can ever, or growth in brands can be the reason, or growth in business can be the reason why you launch new brands. Purely from a marketing perspective, you launch a new brand, or you think of a new brand when you see a mind space that's not being used, or there's a vacant mind space, or a mind space where your brand cannot expand into at this point in time. If you look at our brands, they're very distinct. Mama Earth is a natural plus brand. The Derma company is an actives brand. B Blunt is a completely different segment, which is into styling, etc. So these are all segmented, distinct need spaces that we see opportunity in, and therefore we look at it.
Kirti, your thoughts? What happens, in terms of growth opportunities going forward? You are a marketplace, but there are bigger marketplaces as well. Competitive landscape, how do you manage to hold your own?
Yeah, I think to answer this question, I think it's important to understand sort of where we are today in the broader e-commerce sector. So today, after all the decade and more of investments in e-commerce, still penetration of e-commerce in the country is 5%, right? Which means 95% of retail is still offline. And the next wave of growth, I think, is going to come from the Bharat part of the country. And because the penetration today is only 5%, it just shows that we're in very, very, very early stages, right? And the other thing to also understand is e-commerce is actually not a winner takes all market, right? Unlike maybe messaging or social networking and some of those. So you will have multiple large e-commerce companies being created. And I think the big reason for that is the heterogeneity of the user needs itself. Like I was speaking about Bharat, if you go to Metro Tier 1, the needs are different. And even while I'm clubbing Bharat into one thing, but even within that, there are a lot of micro segments. So because the user needs are so heterogeneous, it is almost impossible for any one company to meet all of them. And that's why I do feel that there is a lot of opportunity for companies to grow big, and there will be multiple probably players who will be large. And we have seen this in other markets which are similar to India. Like if you look at China, right? So very large population, very heterogeneous user needs. Even they have their version of tier 1 to tier 6 markets, right? And you have multiple large e-commerce players there. So I think similarly in India, I do think there is a lot of opportunity for Meesho specifically to grow and tap into this unexplored Bharat segment. And build a very, very large technology-led commerce company. So I think the future is very, very bright. And while competition will be there, any large market opportunity, when it exists, you will have competitors. So that's sort of just the way things will operate. But for us, I think the focus on Bharat segment, the focus on technology-driven innovation, and also the agility and the talent we have in our team, I think these are all the differentiators which can help us really build a large business here.
I think it will, the fact that you spoke about the agility, the talent that you have, as well as the Bharat opportunity, that would apply to everyone on this panel as well. Final question to Atul, actually, I'll just ask Anand this before we go to Atul. Anand, the thing was that D2C or digital brands are successful perhaps by virtue of having long tail sort of niches as well. It's not efficient for one to get into a relatively smaller physical market, but if you club all of them together online, you have a fairly decent enough market for you to launch a brand towards or catering to that very specific need. While this is an advantage, it also becomes a disadvantage, because beyond that scale, how do you diversify? Just the way over diversification or spreading yourself too thin is a risk in FMCG. I think not spreading oneself enough, or under diversification, or being stuck to a certain niche is also a risk. How do companies get out of that?
So it is how you diversify, right? So see, for achieving scale, you will need to diversify. But some of them diversify by getting into the physical channel. They establish themselves in the modern store, in the GT trade, etc. Right? So that is one way by which you can diversify with a niche, but make your product more available and market it to a bigger audience. The second is, of course, on the product side itself. The advantage today is there are so many micro segments present in the market, and there is a willingness to pay a premium if you give that experience, right? And therefore can we also get into multiple categories. I mean, we've repeatedly seen that players which have broadly existed in two kind of spaces, right? So if you're a lifestyle player, you can lend yourself into fashion, into apparel, into health and beauty and wellness and all of that, right? So depending on how well you can diversify your product portfolio and get into multiple categories will determine the scale that you get. And lastly, we didn't discuss this much today, but a lot of our Indian D2C brands are also going international. Right, they're going to markets as diverse as Southeast Asia and Middle East, etc. Because many of the learnings that they have, and a lot has been spoken about technology, sometimes the D2C brands are far more efficient when it comes to the use and deployment of technology, which they take to multiple markets. So geographic markets could be a third way of diversifying, right? So it's always not just product and category. It could be geography, it could be channel. These could be ways by which they can make themselves relevant to a wider audience and get the benefit of scale.
I'm glad I asked you this question before I asked Atul the last question, because my last question had to do with D2C brands going international. And you said we haven't spoken enough about that. Atul, you are investing in enabling that taking place as well, right? What's the kind of opportunity that you see there? Indian D2C value is seen at close to around $33 billion. How much of that could actually truly be a success internationally?
See, I think you have to look at why a D2C brand is successful, because I think Deepak was talking about, you solve a particular customer need, right? And once you have got that consumer value prop right, that need space right, there will be traction, whether the consumer is sitting here or whether the consumer is sitting anywhere outside the country. So I think it again will be a question of access. What you see as access to consumers, which the ecosystem of D2C, logistics or other digital destinations enabled these brand stories to reach out to consumers. As we build better infrastructure of cross-border, of multi-country warehousing, we are talking about within country shared warehousing. As we build multi-country warehousing, I fundamentally believe the first 5 million consumers, if you're targeting the first 5 million consumers, your first 100K, 200K customers, if they love you and if you have got the value prop right, it's just about translating it and reaching out to more and more consumers with that value prop. And that holds whether you are sitting in Delhi, whether you're sitting in Patna, whether you're sitting in New York, or whether you're sitting anywhere else.
All right, I take that point. I mean, another conversation that when we all gather again would be how many companies are doing this actively, how many of them are actually seeking international customers, how many of them have actually, not fulfilled their appetite from Indian customers itself because of the low penetration right now. But that's for another conversation. Thank you so much, gentlemen, for joining in. This was really enriching, and I thoroughly enjoyed listening to all of you.
Thank you. Thanks, everyone.
Thank you.
All right, gentlemen, this has been an extremely insightful conversation. We've learned a lot, and we've also opened a new avenue for a lot more discussion in the near future by getting all of you together. But that is for another time. This was extremely value enriching. Thank you so much for watching.